stock market has had a pretty rough week. We've had a decent pullback in the overall stock market, and I wanted to try to make some sense of it. And also, it's to those that are stock investors, those who are in equities right now, this might not be the video for you, or it might be the video for you. You never know, but I'm just a YouTuber, so not financial advice, disclaimer on everything I'm talking about, just my personal opinion. I think this is just the warm-up. I think it's just getting started. I mean, you have a Fed out there that hasn't even acted on what it says it's going to do, and what they say they're going to do is minuscule at best. So really, to see a market pulling back when they still, let's be honest here, QE is still going on. They still have their money printer. They still have their rates at 0%. They've done nothing. They've talked about what they're going to do, and we see a broad market pullback. And I have some charts over here on the right that I'm going to go over in this video as well. I would be very, very nervous if I was in the equities market looking at it and seeing it pulling back like this without anything really happening yet. Not only has nothing happened yet, but they have signaled that they have to do something. Not only have they signaled that they have to do something at the Fed, but furthermore, they have to do something at the Fed because inflation is out of control due to them printing $13 trillion out of thin air over the last 2 years. Who would have thunk? Who would have thought that you could print over $13 trillion in 2 years and nothing should happen when you do something like that? Inflation won't get out of control when you do stuff like that. The CPI won't get out of control. No, it's no big deal. No big deal at all. So obviously, inflation has become out of control. I'm kidding. And so what do? What is in their tool belt? Well, they said they're going to stop QE. So if the market starts selling off here, what's in the Fed's tool chest is either they do the right thing, they go forward, they taper, they stop QE, they stop printing and diluting the money and putting it in the stock market, which would cause the stock market to crash, and they raise rates. Not only would they raise rates, but they would have to raise rates way, way higher than they're currently saying they're going to raise rates of 0.9% in 2022. So, I mean, if you want to stop inflation, if you want to curb inflation, you're going to have to raise it to well over what the CPI is. And that CPI isn't really correct in my personal opinion. It doesn't really have the right basket of goods in there. They kind of handpick it to make it low. So that 7% is actually a low figure. The other thing I want to talk about in this video, in addition to the stock market, well, this is in the stock market, but bonds are their own thing. Treasury bonds are falling. So if there's one key indicator that there's a lack of trust in the dollar and that the dollar is falsely strong, it would be bonds. You'd want to look, what are they going to do with the bond? It means you're trusting the government, you're giving the government money, and they're holding that capital and giving you an interest over a duration of time, over 20, 30 years on some of these bonds. So I'm going to go over the bonds in this video as well. If you like this content, if it helps you, would really appreciate it if you smash the like button. Really would appreciate it if you click subscribe down there, trying to grow the channel a bit, and it really does help with the YouTube algorithm. Last video we did on silver, it was actually one of my best performing videos over the last month, and I have to thank everybody in these live streams for hitting that like button and helping it get into the algorithm, because the last one, I think it worked on the last one. So thank you to everybody doing that. But let's get over some of these charts over here on the right. I want to talk to you about some of the stuff I have pulled up here. I put a lot of work into pulling up these charts and studying this stuff so I can kind of make it nice and simplified for everybody in here. So I appreciate all the support with people hitting the like and all of that. So let me shoot over to my other screen here. So here is the market. Right now, this is the NASDAQ that I have pulled up here, which is basically tech. And this is the last 5 days, pulled down from just under 16,000 to 14,400. So pretty strong pullback over this is just the last week, last trading week. But let's pull it back a little bit more. So we look here, you go, oh, wow, this is a pretty big amount of to fall here. You know, I mean, it's fallen, here's the beginning of the year, January 10th, 11th. It's pulled back, from 16,000 range. Let's pull it back a little bit further, right? A little bit further. And you go, okay, it looks like it's pulled back a decent amount, but then it's pulled back, let's do like the 1 year, right? Let's pull back the 1 year and you'll start to see how much room it has to fall. So this is just the NASDAQ, right? I like to look at the NASDAQ because the tech sector is really, really overvalued right now. But So this is where you can see like, oh, that's a decent crash going on right there. But let's pull it back a little further. Let's pull it back a little further because the money printer really started in March of 2020. So let's pull it back a little further, right? Here we go to March 2020. That's how you realize how much room it has to fall. This is what QE did. This is what printing 13 trillion out of thin air did. Yeah, you did well. I wish I saw it because in the beginning when I saw this happening, I didn't know how much QE was going to be affecting the stock market. It affected it a lot. That 13 trillion went a long way. People funneled that money in the stock market. The stock market went from these lows here. The NASDAQ was at 7,000, more than doubles even at the current pullback since the money printer started. And guess what's happening? The money printer's turning off. So you have this much of a cushion the money printer gave you, and now the money printer is getting turned off. Interesting. So that goes to show you. So we were looking at, the 5-day. Yeah, that's pretty good pullback there. But I wanted to really show you how much room that market has to fall since that money printer started. There's a lot of room, and those are decent sized candles there. These candles have some strong distance on them that are the recent pullback. So this is how much room it has to collapse down. I mean, I wouldn't be surprised to start seeing, 500 days, $1,000 days, $2,000 days down. That's just my personal opinion on it. But I want to talk about the DXY in addition to this, because last time we went through a recession, which Elon Musk even thinks we're going through a recession. I did a video on that as well. In 2022, he thinks we're going through a recession. So this year, he actually even said before 2023. So sometime in 2022, not later than 2023, even Elon Musk, probably why he sold his Tesla stock, let's be honest. And that was a good sell. Give Elon some credit. His Tesla stock is plummeting right now. So credit to him for selling it at the right time. But I wanted to pull up the DXY. So this is a dollar index here. Last time we went through a bit of a pullback in the dollar index. We're looking at 2008. So this is when the last recession happened. We saw the dollar index go from 120 down. And then 2006 was here, is around 92. And ironically, it's kind of close to where it is now at the 95 level here. And if there's one telling indicator that the dollar index is going to start getting weaker is when you realize that people don't want to park their money in our Treasury bonds. Our Treasury bonds are down. This is the 30-year or the 20. No, this is a 30-year Treasury bond. The 30-year Treasury bond is down to just over 2%. So inflation under their crazy CPI is 7%. And they're going to give you, for locking up your money for 30 years with the U.S. government. This is what, and by the way, this is their balance sheet. They look great. Let's give them a credit line. Wow, almost 30 trillion in national debt. Fantastic. They're like children with a checkbook. That's what they are. Children with a checkbook that don't know what balancing it even means. To them, paying their dues is increasing the debt limit. So they're like, oh, you how much money? 30 trillion? Oh, well, let's increase the debt limit a little bit. Now we paid you. We pay our debts on time. We pay our debts on time around here. That's what we do. So basically, this is the person asking you, when you look at a 30-year T-bill, they're going, hey, look, this is our credit line. They're basically, like, if they rank it, to like 800 or whatever, it's like they're like a 200. Like they have a 200 line of credit, 100 line of credit. I don't even know. Who would give them a credit card? It's so hard for us to qualify for a credit card, so hard for us to qualify for these loans. But to them, they want you to give them their money, and they're going to give you a measly 2% interest for 30 years of locking up your capital. And that is just showing you how progressively nobody wants to get in bonds. And that is a ton of money that needs to flood out of bonds into somewhere else. Probably why we're seeing a spike in silver. Probably why we're going to start seeing a spike in safe haven assets, because that money needs to go somewhere. Where I would argue a lot of this money is going is into that dollar index to sit in hot potato land. I call it hot potato land because eventually I think what's going to happen here, and not enough people are talking about it, if you saw 2008, the dollar index fell down to 70. What people don't realize is your stocks are not only overvalued, not only are the stocks overvalued that you're seeing plummeting down, but also what I want to bring attention to, and not enough people are bringing attention to this because they just see a number on the screen. They just look at, the NASDAQ. They just look at the Dow. They look at whatever their Tesla stock. They just look up TSLA or whatever. I want to talk about something from a bigger macro picture. What is that stock denominated in? It's not denominated in gold. It's not denominated in silver. It's not denominated in Bitcoin. It's denominated in dollars, something that is sitting at a lofty level. That dollar index is sitting up at 95. It has a lot of room to drop. So if your stock market pulls down, what a lot of people don't understand is this compounds with the fact that the dollar index is lofty and could fall in addition to that. So you have a double whammy of pain going on, because if the dollar index falls, that means it takes more dollars to buy silver. So if you have an asset on your balance sheet, it's going to appreciate because it's going to take more dollars to buy that because the dollar is devaluing. However, your stock is valued in dollars. Your stocks are valued in dollars. And so if your stock plummets and it's valued in dollars and the dollar plummets too, you have a double whammy compounding of pain coming your way. And that's something I wanted to bring some attention to, is just that is a very serious issue, that it is what it is. It is what it is. If you agree with me, hit the like button. My thing is I'm trying to look at angles that not everybody else is looking at. And to me, it's like, well, what's the entire stock market denominated in? And oh yeah, the inflation rate they're saying is 7%. And if it continues to not be transitory and it continues this path, that means we're going to have a situation where the inflation compounds year over year. That's what nobody talks about it. Only a few friends of mine I hear bringing this up, and I'm like, yeah, if it stays up there, it's going to compound year over year, this inflation. And compounding interest is not fun when it's working against you. It's great when it's working for you. It's one of those wonders of the world that can just make you a ton of money. But when it's working against you, it makes you stuck. It makes you unable to build and get forward. It's like almost like what's happening right now seems to be a systematic design to damage the working class. It seems like systematic, in my opinion. I'm actually more worried about the stock market than I am about real estate. I made a video on real estate, and what I love so much about the comment sections on these videos, so if you agree or disagree with me, especially if you disagree with me, make a comment, make your voice heard, because there are some people bringing up points about, well, lumber is going to go through the roof, building supplies is going to go through the roof. To pay somebody to build a house is going to be very expensive, so you got to add these types of things into the equation, not just the fact that they need to hike rates a lot. And the truth is, what Powell might do is what he's doing right now is already causing a stock crash. Well, then what they might do is say, hey, we're not tapering anymore, and start up QE. A lot of my friends that are economists are predicting that they might be bluffing here. And it really is one of their two options. Or maybe there's three options. Option A is they're bluffing. They have to start the printing press back up again because they say, hey, we're going to do this at this time. But not right now. Not right now. It's like you caught a kid doing something foolish, and the kid's like, well, "Look, you caught me, but I'm gonna do my detention later. How about like next year? Can we do this next year? Not right now, but like next year." This is how the Fed operates. So they basically say, "Hey, we're gonna do this later on," and when they say later on, they start to see what the sentiment is. They go, "Okay, how is the market reacting here? If we say we're gonna raise rates, what are they doing?" And the market right now is plummeting. And they haven't even done anything yet. So if they do something and the market starts seriously crashing, they're going to turn around and go, oh, we messed up. So this is option A for them. If they do the wrong thing here, this is like borderline evil, to start the printing press back up again and try to keep that market up and start QE back up, even though they said they're going to taper, say they're going to do QE. But here's the problem. Inflation at that point would get up to we're talking we'd have 20%, 30% inflation, because they would keep that printing press going. And then they might even make rates not 0%. They might even make it negative rates. We've seen that before in other countries where they make it negative rates. So they might be begging the banks to take the money. Please, please take the money. But then at the same time, this is where we get like a Weimar Republic type situation where the complete collapse of the currency itself. So option A is literally collapse the currency, devalue the dollar as much as possible, let inflation go to the moon, and ultimately entrap the entire currency bubble. See, what's the difference between today and why I think this is such a problem today is the first crash or not the first crash, but the last crash we went through, 2008, 2007, 2008, 2009 crash, that was a problem with the real estate market. That was bad loans on real estate. This is a currency bubble. The entire currency encompassing all of the dollar, I mean, encompassing all of the stock market and everything, the bonds, everything around it is diluted and going to be devalued. And it's being artificially propped up because people are scared. It's not because they trust the dollar. It's because they're scared of what's going to happen in the market. So they want to have dollars as hot potato money. That's what I see here with the dollar index being at 95. And as soon as they find somewhere to put that money, wherever that might be, that dollar index is going to start plummeting. As soon as people realize, hey, I don't want it. What even is a bond at this point? What type of fool would put their money in a bond that's paying them 2% to lock up their capital for 30 years? That's basically saying, hey, steal all my money from me. Here's money I want you to steal from me. It is being diluted and devalued at what you say is 7%. I personally think it's well over 15%, and they're not using the correct CPI that they used back in the 80s. If they use the same CPI, it would be well over 15% right now. But I digress. It's basically saying, hey, I want to lose 5% of my purchasing power year over year over year, and in 20 years, I'm going to have 100% of my purchasing power destroyed. Like 99% of my purchasing power is going to be destroyed at this rate, just this current rate. But if you start compounding it, you start realizing inflation is going to compound. That's where it gets really scary here. I mean, who in their right mind would put their money in a bond? The fact that any money exists in that bond market is laughable to me. And I think there's going to be a ton of money flooding out of bonds looking for a place to park that money. And that might be why we see that dollar index sitting there at a lofty price. But let's go back to this real quick, just to show you what I'm talking about. So this is a dollar index. Basically, it's right now it's sitting at 95, but I think my prediction personally, I think that it could easily get to where it was in 2008. I think it could easily fall to 70. I know everybody tells me, hey, it's the cleanest shirt in the dirty hamper. It's the cleanest shirt in the dirty hamper. Well, what if the whole hamper has dirty laundry in it? What happens when you actually do the laundry? Do we want to have all the currency of the world considered to be, the clean, which one's the cleanest shirt in the dirty hamper? What I think is the entire basket of fiat currencies falls down with a dollar maybe staying above the other parts of the basket. But that whole basket, including the dollar, could easily fall down, and it has a lot of room to go. So I think conservatively, the dollar index could easily fall to 80, 70, go back down to this range that we saw in 2008, down to 70. So what's so scary here is you see this, if there was trust in the dollar, you would see Treasury bonds be higher. You'd see that there is trust there, but the Treasury bonds are selling off. Same thing with the 10-year. This is the 10-year Treasury bond. This is down to lock your money up for 10 years. They won't even pay you 2%. 1.76% is what they'll pay you. Oh my, the banks get money for 0%. Zero. They get free money. But the people, if we lock up our money for 10 years, oh wow, thank you so much. Wow, thank you so much. I feel so grateful to lock up my money for 10 years and make 1.76% on my capital. Who is going to buy a bond? Who? What fool out there wants to buy a bond? Like, what kind of, this to me is like a Ponzi. Like, why would you ever want to do that? The fact that it just blows my mind. And if I'm going to lock it up another 20 years, that was the 10-year here. So this is a 10-year bond. If I'm going to lock it up for 20 more years, I'm going to get a measly, 0.3 more percent? No, 0.24% more? Yeah, 0.24% more if around that range. 0.24 to 0.25% more, or whatever that is. That is insanity. They're going to give you a measly, not even a 0.3 more, not even 0.3 more in interest on your capital, when inflation here is literally rapidly going from, in 2020 at 1.36% inflation, now it's at 7%, not even using the right CPI. Not even using that. And this back when we went through this type of inflation back here, back in 1979, 1980, they used a completely different CPI back then. If we use the same CPI that we used in 79 and 80, this would show that we're well over 15%. It would show that we're around here, but they're using their own hand-picked behind closed doors CPI data that gives us still a 7% inflation. But what I'm more concerned about is the year-over-year growth. Going from 1.36% to 7% is multiple hundreds and hundreds of percent. You're talking about 500% plus, going from 1.36 to over 7%. But when we had the last time we went through some serious inflation, it was not even a double. Went from 9% to 13%. So there's obviously something extremely irrational happening here. There's obviously something that we're not seeing when we look at this data, because that year-over-year growth, if it does that again, if say we had, this is roughly 5x or something along those lines, right? Say we did another 5x next year. If we grow from 2020 to 2021 at the same inflation rate that happened, you're talking about you'd have to multiply 7% by 5. You're talking 35% inflation. If we just did the same jump that we did from last year to this year, if we do that one more time, you're talking 35% inflation. You're talking the ultimate trapping of all the working class, all the middle class, and the rich will get uber rich. Rent prices will be through the roof. Everything will cost a fortune to buy. Your groceries, your gas, everything will be a fortune. And arguably, it could be to 15 to 20% right now. So that's what people don't understand. Is if this same rate happens one more time, you're talking a jump up to here. Talking this going, boom, 35%. That's insanity. And the scary part, the most scary part about it is this is something the Fed is going to cause if they decide to kick the can down the road. If Powell decides to not own up to how bad of a situation this is and how the market needs to correct, how they have to raise rates higher than the CPI data, how they have to taper immediately, and they have to go way over 0.9% that they're going to do in 2022, then you see the markets plummet. And that's where we see the equities market. I mean, this was just not even like the tip of the iceberg. I mean, this could just absolutely plummet from him doing that if he did the right thing. But if he decides to not do the right thing, which is what they have proven to do time and time again, to not do the right thing and kick the can down the road, then what they will do is they will start the printing press back up and make that inflation rate jump to those crazy levels, in my personal opinion, to 30-40% inflation rate, where basically like you just need to get rid of your dollars immediately. You do not want to sit on dollars at all. It'll be like the ultimate hot potato and the currency will inevitably collapse. And then you're talking what your stocks are denominated in. It doesn't matter what the price of the stock is if your currency is devalued and worthless. And so this is why it's so important right now to find safe haven assets. I happen to think that pullback, I'm big on silver. I'm big on my precious metals, especially my utility precious metals, as you know me, and platinum and palladium. If you look at that chart on platinum and palladium, it's starting to go in the right direction here. But Bitcoin's on a serious pullback. So, I mean, if I had no Bitcoin right now, personally, this is my personal opinion, not financial advice, I'd have like a 5% position at these levels just as an insurance play, because as crazy as Bitcoin sounds, to all of the precious metal stackers, as crazy as it sounds, at least you know that it has a finite amount and it's not controlled by any government. At least you know that it's really decentralized and it's in the digital realm. So in my opinion, that's like, I want to have it as an insurance policy. You know, I think it's foolish to be all in and equally foolish to have none. Those who are all in Bitcoin got hurt pretty bad recently, and those who have none don't have that potential upside that it could have. So it's like there's only so many options on where to park this money, and I think it's going to flood into safe haven assets. I think it's just a matter of time. And what I think really will happen is, I mean, when you think about how much money is in bonds and how much money is in equities right now and how diluted that dollar is, and you realize that if you put all the precious metals together, if you put platinum, palladium, rhodium, silver, gold, all in one basket, you're talking about less than 15 trillion, just to make a broad number. When you have hundreds and hundreds and hundreds of trillions of dollars out there looking for a place to park that money, you have a tiny price of 15 trillion of these, and I think you could even include Bitcoin in there. If you put all the precious metals and Bitcoin, it'd be less than 15 trillion, I believe. And so it's like, okay, all of the hundreds and hundreds of trillions out there is looking to find a place to go. I think that is a major, major opportunity for safe haven assets, because it's got to go somewhere. And really, option A is print the money into oblivion. And that would make safe haven assets skyrocket and make a currency collapse. Then option number 2 for them would be to make the entire stock market collapse by actually raising rates. They would actually have to raise rates, and then they would actually be in a situation where the stock market collapses. Everything, it would be a complete chaos. They taper, they stop the money printer, and they raise rates, and they raise rates much higher because they need to raise rates higher than the CPI. Talking a serious market collapse, and this is what happened in 81. We went through a serious recession last time. They had to raise rates and they had to stop inflation. And at some point, they're going to have to own up to it. Now, are they going to own up to it this year? Are they going to own up to it next year? According to what they say they're going to do, I don't think so. But it's just a matter of time. So really, I just want to park myself in these assets before this all happens, before the things hit the fan. I want to be in the right places, and I also want to make sure I'm doing cash flow. When it came to the real estate video I just dropped before this, I should have been more clear in that video that I'm talking about if they decide to raise rates to like 20% to actually stop inflation like they did in the 80s, like Paul Volcker did. If they actually do that, then you're talking people are going to get very conservative about the real estate they buy. Because the other thing a lot of people don't talk about real estate, and this happens even in states like Florida, states like Texas, where there's not the state tax, when there's not the state, instead of just the Fed tax, there's not the state tax as well. There is unrealized capital gains already, unrealized capital gains taxes like Yellen's talking about on real estate. And a lot of people got to take that in consideration. I should have said this in the video. I didn't. I'm going to say it here when it comes to real estate. These property taxes are intense. So if you have a high price tag on your real estate and so real estate's already in a bit of a bubble and gone up a lot, but you have to pay a tax year over year over year over year for forever on your real estate, you're paying unrealized capital gains taxes whether you know it or not. That's really what it is. I mean, property taxes really is unrealized capital gains tax that Yellen's talking about. We already do that with property taxes. I should have brought that up in the real estate video. That was another main reason why I think real estate could possibly be a bubble right now as well. But the market, the overall stock market, I would be much, much more worried to be in the overall equities market than to be in real estate right now. I would prefer real estate over the stock market. The stock market to me is just so ripe to get nailed right now. So ripe. Every price to earnings ratios are pretty much non-existent. It's had a ridiculous jump since they started the printing press in March of 2020. And really all of the options it just causes failure in the stock market. There really is no good option for the stock market. If they do decide to do QE again, which a lot of people are saying that's a possibility, and I agree, that is actually, I would say it's like a 60% probability that they in 2022, they decide to not taper and start the printing press back up to save us from collapse. Now, what that does is just pours gasoline on the fire and holds the fire a little bit further away, or pours gasoline on all of this kindling and puts the fire just a little bit away, and eventually that fire is going to go to the kindling. Eventually it's going to happen. So they could kick it down the road, and that might buy you another year, might buy you another 6 months of the stock market staying at the current levels or going slightly up if they decide to do the printing press even further. But inevitably it will collapse by doing that because the dollar itself will become worthless. So really, and inflation at that point would just be, just wild. Could you imagine a world where inflation was like 30, 40%? If they decide to do more QE, that's where we're headed. So it's just absolutely wild to me, this entire situation. If you agree with me, please do smash the like button. Please do hit the subscribe. I'm getting so close to that 25K mark on my subscribers. So that's the recent mark I want to hit. I'm like 24,800 subscribers. So if you agree with me, if you agree with all of this, would love to have you as a subscriber on the channel. And if you click the bell afterwards, you'll be notified of all future videos. I'm also been giving, because sometimes the notifications I've been told are taking a little bit too long to get to people on YouTube. Sometimes, I'll be live and they get a notification like an hour into the live feed or 30 minutes into the live feed. So I'm also putting on my Instagram story whenever I go live. I've been doing these Friday night lives pretty consistent as of recent. I'm doing them around 7:30, 8 o'clock. So I'll actually set the time in stone, but expect a live feed every Friday from 7 o'clock to 8 o'clock range, somewhere in that time period. I feel like that's a pretty good time. But in addition to that, on my story on Instagram, I'm saying, hey, I'm going live in 15 minutes. Hey, I'm going live in an hour. Hey, I just dropped this video. So if you want a notification, like a certain notification, head on over to my Instagram. And also if you want to see all the collectibles that I'm into, all the watches I'm into, things like that, shoot a follow to me on Instagram at Soltan. I've been posting a lot more over there on the Instagram. And then you can also shoot me a DM there as well. I've been getting back to the DMs. I'm starting at the bottom and working my way up. I think I have another 100 or so to get back to, but I have been working up that list. So if you have shot me a DM, I will get back to you. Just give me a little bit of time because there was a few hundred of them. But yeah, I will be posting a lot more there as well. And if you want a notification, that way you can, for sure when my videos drop or anything like that, shoot me a follow on the Instagram. Again, at Soltan on Instagram. But this is basically everything I want to talk about with the overall stock market and why I'm so scared about it. I think that really the Fed has put themselves in a place where they don't have any options, and all of their options cause a collapse in the stock market, or it temporarily suspends the collapse in the stock market. So it just temporarily holds. So is there money to be made? Possibly if they decide to do the QE again, but honestly, I wouldn't want to be in that risky scenario there. And I think smart money is getting out of bonds. They're getting out of the dollar, they're getting out of the equities market, and they're finding safe haven assets. Maybe they're investing in their business. I think that's probably the best if you have a good business to get you cash flow. If you have your own money printer, then you're in a situation where you can actually, change your prices. Why did the dollar store change their price to $1.25? Because they have to realize inflation is probably around 25%, probably around 20-25%, like the real numbers that actually affect things. And so you'll see companies and people that own their own businesses changing their prices up to compensate for the inflation level. But then what does that do to the working class? The working class, their rent goes through the roof, all the cost of their groceries, all the cost of their gas. They're going to have to start selling their equities just to pay their bills. It's like this world is going to get very, very scary with these kind of inflation levels. And when we have a Fed that acts like, children with a checkbook, I mean, it's a rough scenario here. There really is no... There's no good, because even if you're like, if you are excited about them possibly, their bluff gets called, the stock market starts collapsing before they even raise rates, then they have to completely change everything that they said they're going to do and say, hey, actually, we said we're going to taper, now we're going to raise rates, and rates are going to go through the roof now, or we're not going to raise rates, we're going to go to negative interest rates rather, and we're also going to raise QE again. We're going to start printing the printing press. And now if that happens, you might be artificially happy in the stock market. You might feel like, oh, wow, like now we're going to make money in the equities again. But overall, it's just waiting. It's just gasoline on a fire waiting for that match to get dropped on it. And they're just pouring more and more gas on it. And eventually that match gets dropped. And so it's just going to be a worse collapse than what's inevitable. And they have to do the right thing at some point. It's just a scary time. It's a scary time because, again, 2007, 2008, 2009, that market collapsed due to just bad loans on real estate. That was just bad loans on real estate. This is the entire currency. The entire currency itself is diluted. All of what your stocks are denominated is diluted. That is absolute insanity. Absolute insanity to me that this is what we're going through right now, and there really is no way out. Besides kicking the can down the road, maybe you buy yourself 6 months, maybe you buy yourself a year. But if the market's already pulling back like this when they're just signaling, they haven't even done anything, that's some scary stuff. But again, when I talked, the video I dropped right prior to this one on real estate, because this one's on the stock market, I want to be very clear. I am much more scared about the stock market than I am about real estate. With real estate, if you have cash flow, if you know what your expenses are, you're tied on a 30-year loan, and you know what your overhead is. If your mortgage is two grand a month, let's say, and you have a consistent $2,500 coming in, that's different. You're in a situation where, despite the fact that the market might crash in real estate or might be a bubble, you still have money coming in and you're going to be all right. You're going to pay off that loan and then you're going to have an asset there for free. So there are places in real estate that make a lot of sense. I'm mainly talking about people that have a mortgage just for their own home that they live in. They're not making any cash flow off of it. Now, if you're in real estate to make cash flow off of it, I should have been more clear in that video I dropped prior to this one that that's a different scenario. There are ways in real estate. If you're a flipper, if you're buying, fixing it up quick and flipping it quick, there's money to be made there. If you're in a situation where you're doing cash flow off of it, there's money to be made there. So I understand that part of real estate, and I think that that is a great place to be if you know how to do it right. Now, you have to be pretty skilled to do that. But if you are in that situation, it's much different than the overall equities market. But the other thing you have to consider, though, is the property taxes. So if you're not in it for a quick flip, if you're in a situation where you're just buying real estate to buy it for yourself or whatever, and you think that it's a good investment to just sit and live in it, well, you got to consider property taxes, that you're going to get unrealized capital gains on that property every single year, and it's not going to stop. And they know where it is, and so that's a very scary situation there. They will even revalue your home and tell you what it's worth and change your property taxes on you. Like it's insanity. The kind of that is something a lot of people don't think about when they think about real estate, but that's something I should have said in the video. I wanted to clarify that right now. But overall, I own, just to be very clear to everybody, all of my viewers out there, I own 0 equities. There is not a single equity out there that I look at and I think it's, oh, I want to be in that company. I look at Tesla and I think, wow, they're doing amazing stuff. Wow, you have a great product. I love your car. I think your car is better than all the other cars on the road. I think you're doing great things in the energy sector. I think you're really going to do some really good work with Tesla. Now I look at the price to earnings ratio and I go, what am I investing in? Like, how much money do you make? What's your price to earnings ratio? It's pretty much non-existent. So it's like that's the kind of thing that I'm looking at right now. And obviously, even Elon Musk himself said, hey, I think a recession is imminent in 2022. I showed you that in the prior video, the prior live stream that I did with Elon Musk's, imminent warning of a recession in 2022. And he sold his stock. And he sold his stock higher than it is right now. So his stock's had a pretty decent pullback. If you look at, let me pull up real quick. So we pull up Tesla. Yeah, Tesla stock fell $52 today, down 5% today, down to 943. So this is the Treasury bond I was showing you, the 30-year Treasury bond. Again, who the hell is going to buy a Treasury bond at 2%? I have no idea. I have no idea who would buy that. But let's go to Tesla. So this is like one of the overvalued tech stocks here. I mean, you're talking about from March of 2020. So when the printing press started, Tesla was down at around 140. And now the printing press started in March of 2020 and it's up to 943. You think that has some room to drop? You think that has, I think it has some room to drop. I'll be honest with you. I think it's got some room to drop. So, if we look at, let's pull up the 5-year. Yeah, March of 2020. Yeah. So this is like one of your overvalued tech companies. This is where you see the NASDAQ falling down as much as it is. You see one of these tech companies just plummeting like that. I mean, it's scary. You look at Peloton, you look at like Zoom, you look at a lot of these companies that were like the pandemic winners. They're all plummeting because they got overvalued. And so I think that there's a lot of room for it to fall. I think that NASDAQ has a lot of room for it to fall. It's jumped quite a bit. Look at that candle right there. That is a serious candle going down. And I mean, this is when they started the printing press. This is when QE started. So if they stop, so this is when the printing press started. If they stop QE, you're looking at this just starting to plummet. I mean, could easily plummet down on the NASDAQ, could easily plummet on the S&P. Let's look at the S&P. Same thing. You see a huge candle drop. Look at the Dow Jones, huge candle drop there. And it's just, the thing is, this is like sitting, waiting to collapse. It's not like there isn't room for it to fall. There's a ton of room for it to fall. This is where the market was in a panic here at the beginning of all of this. Major panic, huge drops, and then they started the printing press and saved the market with the printing press. We're going to see a similar thing where the market starts plummeting down, and they have a choice to make. The market plummets down here. So right here this is when they first had to deal with this when they started the QE. Market's plummeting. They start the printing press. They print $13 trillion, half of this deficit, roughly half of it, in less than 2 years. They do, and they save the market by doing that. They print 13 trillion out of thin air, save the market here, and then it gets it to here. Now, what's going to happen, in my personal opinion, you're going to see the market collapse again, pull down to around here, and then Powell is faced with a tough decision. Right when the market's around here, Powell's going to sit there and go, what do we do, guys? The market's collapsing. We said we were going to taper. We said we're going to raise rates a little bit. Okay, we're going to have to go to negative rates, and we're going to have to start up QE again. And we're going to have to print another 15 trillion out of thin air. And they might save the market from here and bring it to like right here, and then when it's here, you'll see the dollar index start plummeting. You'll realize that the currency starts collapsing because the currency itself is already sitting at a lofty level. It's sitting up at 95. It could easily be at 2008 levels and be around 70 right now. So the dollar index would plummet in that situation, in my personal opinion. So, I mean, there's so many things that could happen here, but I mean, that's really best case scenario for people in equities is if they decide to do QE again, market collapses, they change their mind, they get called on their bluff, they start the printing press back up and save it. But then what happens if now here's an interesting scenario. What happens if they start the printing press back up and it doesn't save the stock market? What if that happened? What if they started the printing press back up and the stock market stayed flat or the stock market kept selling off? And then you just have inflation through the roof, an equities market plummeting, and they can't do anything about it. And then also the dollar's plummeting as well. So it's like there's so many things and so many questions that I have. And I'm not a guru. I just like to expose things. I learned so much from the comments. Like I said, on that real estate video I dropped, I missed a couple points that I wanted to bring up. I missed talking about property taxes. I missed talking about, you know, if you're doing it for cash flow, that kind of thing. I should have said that in that video, but a lot of people pointed that out in the comments. So I really rely on everybody in these videos in the comments to say, hey, like, make your voice heard, guys. Make your voice heard, put a comment in the comment section, and we can discuss with each other there. And I always read all these comments, and I learn so much. People that they also brought up in the comments in that real estate video, you know, the cost of lumber, the cost of building a house, all of these things are going to go up through the roof, so it might be a hedge against inflation. So there is that to consider. So if you're smart and you know how to put the money in the right places, then real estate might be good. But at the same time, it's like the options are so limited. And a lot of these real estate markets are just wildly overvalued right now. So I don't know. I mean, if you can tie up a 30-year mortgage at 3-point-some odd percent when you know inflation's at 7%, I mean, that's kind of free money if you know how to put it in the right places. And that's why we're seeing the real estate market blow up, you know. But at the same time, if they take that away and those rates go up and it gets harder to get a loan, that also affects the real estate market in a very negative way. So that's how I feel about the whole situation. Yeah, you know, maybe we can get to the comments here, and let's start talking in the comments. I'm going to read some of the comments in here. Let's see here. It's showing that my screen is frozen on my end. Is it frozen? Let me know in the comments if my screen is frozen, guys, because it shows that I'm frozen, but maybe it's just my screen. Let me know. I'm reading the comments right here, right now. I can see comments coming in. It's frozen. People are saying it's frozen. Okay. Well, subscribe to the channel if you can hear me. Can people hear me? If you can hear me, I'd appreciate it if you can subscribe to the channel, because then, you know, I don't know why it's frozen right now. I guess we were talking too much truth up in here. It tends to happen right when we talk about enough truth for about 40 minutes. So we're in a situation where we're frozen, but I guess everybody can still hear me. So please do make sure that you're subscribed to the channel. Subscribe to the channel. It's in the left-hand corner or right-hand corner, that red square. If you're not following me on Instagram, please follow me on Instagram as well, at Rob Soltan on Instagram. I guess I will end this live stream, and I will see you all at the next video. So please do, again, make sure to subscribe to the channel. If you can hit the like button, would really appreciate it if you hit the like button before you head out, because it gets these videos out there to more people. I really appreciate you. Thank you all for being here. Again, please do follow me on Instagram, at Rob Soltan on Instagram, so that I can give you a notification there. And I have another platform as well in case, you know, things get frozen or whatnot. So please do follow me on Instagram, again, at Rob Soltan on Instagram. Yeah, I guess everybody can hear my voice, but I'm frozen on my screen, so I guess I'm frozen here. But at least we were able to do this video for a really good amount of time. So we're going to post this video on the channel, and at least the video will be posted. Again, please do follow me on the Instagram. I know I said it like 100 times, but it makes me have another platform to be able to tell you guys when I'm dropping my videos and to be able to get this information out there. So please do that. Thanks again for being here. I will see you all at the next video. Signing out.